Hi, everyone. Welcome as you're joining. We're just going to give it a minute or two as people trickle in. And we can allow people to trickle in as they need to over the next few minutes, because Isabel will be moderating attendees and whatnot. But I might, in the interest of time, kick off. Just before we start, a few housekeeping matters. So the session is being recorded. Hopefully that is okay with all attendees. Also, we will be making the Q&A function available for any attendees who'd like to ask any questions during this session. You should see that up on the top side of your screen. You have the option to post under your name, or indeed you can post a question anonymously if you'd prefer to do that, and we'll deal with those as we go. And indeed, at the end, if anyone would like to make a comment or speak to the meeting as a whole, we can absolutely allow that. Just for the purposes of the running order of the meeting, attendees are currently muted, but if you'd like to raise your hand using the raise hand function there, we would be happy to unmute you and you can engage in the conversation at the end. So just to kick off, thank you to everybody for joining. I'd like to do some brief introductions before we start. My name is Aisling O'Mahony and I'm the project leader of the Funds Academy at Munster Technological University. I'm joined by my counterpart in South East Technological University, John Casey, as well as our webinar coordinator, Isabel Rossiter, who'll be ensuring that everything goes smoothly today with the webinar. Today, we're going to be giving you a little bit of an insight into ESG and sustainable finance. This is as part of the Cork Lifelong Learning Festival, and a number of our colleagues have also expressed interest in viewing this after the fact, given they can't attend live for whatever reason. So we will be allowing this to be circulated after for anybody who'd like to watch the recording. So you're all most welcome, whether you're watching live or as part of the recorded series. Today, we're going to be delving into some high-level areas relating to ESG. We're going to be talking about the actual impact it's had on financial services, and indeed, we're going to be opening it out to the floor for anybody who'd like to engage or offer their own thoughts on this space. So we might just kick it off. I'm going to pass you over to my very capable colleague, John Casey, to start off with how we got here and the context for this, or as we'd like to call it, the theory bit. Thanks, John.
Okay. Lovely stuff. Thanks, Aisling. I suppose, like, how did we get her that side of things? I think if you kind of take more of a longer term view on this, I guess our societal model has been really successful, and we have made huge development advances over, say, the past 200 odd years or thereabouts, not just in Ireland. And I suppose just to put this in context, I mean, I'm not talking about, us using mobile phones and computers, and here we are on a call together, and it's a great technological advance. Really, what I suppose I suppose our best measure of how much we've advanced over the past 200 years, and these are Irish statistics. In 1850, in the middle of the famine, life expectancy in Ireland was 21. Okay. Then it rose around the kind of the birth of the state to about 54. We're now at 82. In 2020, life expectancy is 82. That's about as best a measure of development as we can get. Huge advances in life expectancy. And also, at the same time, not only has the life expectancy improved, but the spread between rich and poor has narrowed considerably as well too. Because back in the 1850, if you were wealthy, you had you weren't going to be dying at 21. However, I suppose the impact of all these advances that it has come at a cost, and the cost is largely, I suppose, as we can probably see, is to our environment. And I suppose it's kind of worth our while asking why this has happened. And there's a couple of explanations. I'll just kind of look at one. One is largely around our economic model. And our economic model doesn't necessarily price in the impacts of all of our activities. So, for example, when we drive our cars and so forth, the pollution impact of that is not reflected in the cost of driving our car. When we plug our electrical appliances into the wall and use electricity, the cost of using that electricity, it doesn't really distinguish, at least up until recently anyway, between how that electricity was produced, be it produced using, say, fossil fuels, or being produced using renewable sources. And again, up until recently, the cost of using fossil fuels to produce electricity was way cheaper than using renewable sources. Economists would call this kind of an externality. But we now realize that we have to change, and change is coming because of the impact that all this development and growth and expansion has had on the planet, and that change is coming. And there's been a lot happening at the EU level around this. One of those changes is coming on the financing and economic side, and that's, I suppose, what we're going to look at today in a bit more detail. So on the screen there, you can see one of the EU action plans on this, looking at how we're going to move from a financing and an economic perspective and an investing perspective. The EU Financing Sustainable Growth Plan from 2018 is kind of the EU activity in this regard. And just before we kind of get ourselves all beat up on this, we have had some successes at a transnational level in dealing with environmental issues. If you're old enough to remember the problem we had with acid rain, we've pretty much we've dealt with that to some extent. In order to, I suppose, resolve some of these issues that are taking place from a climate change and other perspectives as well too, the EU have mobilized, and they have mobilized on a couple of different dimensions. One of those dimensions is on the financing side, and they have an action plan on financing sustainable growth at 2018. Our own Commissioner, Mairead McGuinness, would have been deeply involved in implementing this. The main objective of all these EU action plans is to try and keep global temperature increase to below 2 degrees, and I guess in reality try and keep it below 1.5 degrees, although there is some evidence out there that suggests that we're going to struggle to meet that 1.5 degree target. And I suppose from when you're looking at the action plan on financing sustainable growth, it really has, I suppose, three kind of legs to it. The first leg is to try and ensure that when people are making investments, and by and large, the investment fund industry will be one of the contributors to that. When people are making investments, that those investments are skewed towards sustainable investment activities. So, for example, we want to encourage investment into wind farms as opposed to coal mining. We want to encourage investments into producing electric cars as opposed to producing internal combustion engine cars. So that's what a lot of, I suppose, what is how the regulations are moving towards that particular goal, with a view ultimately then as if we can improve our sustainable activities, then we have a better chance of ensuring that our global temperature does not increase to that 2 degree kind of limit. The other part of it then as well then is, at the same time, we want to make sure that as climate change does occur, and there's some evidence that climate change is happening, we're going to be experiencing more extreme temperature fluctuations, more extreme weather events, that the financial risks stemming from this can be managed. And a lot of this is clearly falling on the insurance industry. And we need to make sure that, as people get impacted across Europe, in different places at different times, that we can manage that from a financial and from a human perspective as well. And then the third aspect is that what we want to do also is we want to ensure that the marketplace moves from something that is very much a kind of short-termist, looking at kind of quarterly profit announcements and even daily and weekly share price movements, into something that's more longer term in its view. Okay, so Aisling, if you maybe move on to the next slide. So that's kind of the broad kind of situation or context for what we're going to be looking at today. So has our slide deck? Oh, yeah, I can do that. There we go. Wow. There we go. I didn't know I could do that. So I suppose just some of the jargon that we're going to be talking about. ESG is short for environmental, social and governance. Ashley's going to talk to that in a little while. Net zero, something that you may have heard as well too. This is this idea that we want to ensure that there's a balance, in other words, the balance being zero, that the amount of greenhouse gas that we produce is offset or is equal to the amount of greenhouse gases that is removed. And many companies have taken this on board and have, I suppose, pledged to be net zero by a particular point of time into the future. So that means that if I'm a company in the oil industry, now I might have to diversify into other industries, but the amount of greenhouse gases that my oil producing activities result in is offset by other activities that I engage in. And then the last piece is something that you might also have heard of. This is this idea of carbon offset. You might have seen this when you buy a Ryanair flight. This is hugely contentious, and it's largely, I think, at this stage been nearly debunked, although some people still swear by it. But this idea of buying a few trees to offset the kind of the environmental impact of your flight, it's a bit like going to the going to the pub first, or sorry, going to the gym first and then going to the pub afterwards. It does have some impact, but it's worse than just going to the pub straight. But probably not the healthiest thing to be doing on a recurring basis, at least anyway. Okay, so I think on that basis, I'll switch over to Aisling, and she might chat a little bit more about ESG and get under the hood of this a little bit.
Thanks very much, Sean. Yes, so I suppose we often hear of the acronym ESG, and what we wanted to talk about today is what exactly does that mean? What comprises E, what comprises S, and what comprises G? It's become pretty in vogue in recent years to talk about the concept of ESG and sustainable finance, but it's often important to stop and think about what are the subcategories within each of those. So I propose we just spend a couple of minutes having a look at that, and maybe chatting about the impact that the different categories might have on businesses and indeed on financial services firms that are investing in these businesses, whether they be regulated funds or otherwise. So the first area that I wanted to look at was the E. What constitutes E when you're thinking about ESG risks? And investing in companies that subscribe to ESG principles. So E can be a broad range of items. There is a new set of regulations that have come out that are seeking to hone the description of ESG, and particularly the E piece in the first instance. So the EU taxonomy is one that is looking to, I suppose, standardize the notion of E across the EU. But some of those subtopics that have come out of that are the likes of air and water pollution, biodiversity, climate change, deforestation, water scarcity, land degradation, and resource depletion. So there's a wide variety of subtopics there under the E section alone. Many people think E is just climate change, but actually it goes far beyond that. I suppose you can think of the impact on certain biodiversity areas, particularly if you think of the likes of the barrier reef and the impact that climate change has had on the biodiversity in those areas across the world. When you think of the depletion of our water quality, the risks of ESG pollution through the likes of oil spills, etc. All of that can constitute the E in the ESG, okay? And one area that John has already mentioned is the issue of fossil fuels and resource depletion. And obviously that is a key focus of the EU as they look to transition to a net zero economy within the next number of decades. So resource depletion and I suppose the reduction of the dependency on resources that are finite, so the likes of oil and other resources such as that, and a transition to cleaner renewable energies is a key focus of the regulators and indeed industry at the moment, okay? Just I suppose then to have a look at two of the slightly lesser known letters within the acronym, the S and the G. What exactly does S constitute within ESG? I suppose in the first instance, it can constitute how your company acts in a social capacity, okay? Is it acting for the benefit of society as a whole? Is it actively taking care of the society in which it operates? And is it acting with a social conscience and in accordance with the principles of social justice? So this could encompass things like product safety, labour standards, an impact on its local community, and indeed human rights. And what's important to understand in the context of the S within ESG is it goes beyond the company itself. So one issue that has come to the fore in recent years is supply chain and the ESG credentials of the chain suppliers within a company's supply chain. So for example, if you buy a piece of clothing from a shop and the shop says, yes, we are acting in accordance with the S principles that we've set out in our ESG policy, we pay our workers a fair wage, we make sure that they get adequate holidays every year, we ensure that the environment in which they operate is safe, that they are not operating unsafe machinery without appropriate training, etc., etc. That's fine, but actually now there is an onus to look beyond the company itself. You need to look at things like how do their suppliers act, okay? So if a supplier is in another country, for example, and supplying into that company, are the company taking responsibility for how that supplier treats their employees? So it goes much further than just the surface level of the S that a company is conducting on a day-to-day, okay? So that's, I suppose, the S side of ESG. I've had confirmation that most people can see the slides at this stage, so hopefully that's just a once-off issue. Apologies for any viewers that can't see it, but I think they are visible mostly across the webinar. I'm going to move on to the G then, and G constitutes governance, okay? This is obviously a key area when it comes to financial services and financial accounting, because good governance forms the bedrock for how a company may do in terms of succession. It also forms it also forms a key part of how the company is seen reputationally, and also how the company will continue to operate. So G can constitute anything from accounting to audit to how the company looks at its board composition to its EDI credentials. So for example, is the company making an effort to have sufficient inclusivity and diversity across its staff? Is it exercising equality in terms of how it treats its staff? Does it have policies in relation to equal pay, ensuring that people are accessing equal opportunities? So there's a broad remit there under the equality and diversity sub-theme. Another area of governance is bribery and corruption, remuneration and how a company remunerates its staff, and indeed any policies that are in place that could be seen to be counterintuitive to good governance. For example, if remuneration is encouraging excessive risk taking, or if it's done in such a way that is anti-competitive, etc., that can also fall under G. And then finally, shareholder rights and voting rights is a key function of G. So in recent years, we've seen a strengthening of shareholder engagement with the companies in which they invest. Many people might think of shareholders as individuals that buy shares on the stock market, but shareholders could be large organizations that invest in funds or invest in other companies. And these larger institutional shareholders, which is what they're called, have a serious part to play in the ESG credentials of the companies in which they invest. So you can exercise your shareholder rights by engaging with the company. So for example, if you are a large shareholder in a company that is doing something that you don't agree with, then you can exercise your voting right in an attempt to sway that company to do the right thing. If you are invested in a particular area of industry that you think could enhance their green credentials, then it is up to the institutional investors to place the requisite pressure on that company to see if they could change the way in which they act, to see if they can do anything to enhance perhaps their green credentials, to see if there's anything they can do on the S side to enhance their social activities, or indeed if there's something on the governance side that that the investors feel is not being vindicated, whether it be board composition being unfair, whether there is a lack of equality and diversity evident in the management of the organization, or otherwise, then shareholder rights and voting can have an impact in that. Okay, so just to move on then slightly from that, I wanted to just touch very briefly on what this has to do with funds and financial services. Okay, so we have a range of attendees on the call. Some may be working in funds, some may be working in financial services, and some may not be working in the financial services sector at all. But it is important to think about how all of these ESG criteria that companies are now thinking about impact on funds and financial services. So there is an onus now on financial services to take ESG considerations into account. There are a wide range of regulations, which I'll touch on very briefly in a second, that are now forcing funds and indeed investment banks and other financial services institutions across the globe into considering ESG, into considering how they are planning to implement ESG considerations within their own investment strategies. It is making them look at their own products and the investments in which they invest. So for example, if historically a fund never took ESG into consideration, they are now for the first time having to take it into consideration and disclose to investors as to how they take that into consideration. And that is a key change that has come about in the last number of years, okay? And that impacts on the classification of new funds. So funds that are being created for the first time will need to consider the extent to which they want to implement ESG strategies in their investment strategies. And we'll maybe touch on that very briefly in a second when we talk about something called the Sustainable Finance Disclosures Regulation. All of this brings about a risk of greenwashing, and that's both at company level and also at fund level. So if you're holding yourself out to be a green company, if you are saying that you are acting in a green way, then you need to ensure that that is actually the case, as if not, you could be accused of something called greenwashing, which is essentially pretending to be a greener company than you are, okay? An issue that has come to the fore in the clothing industry is where companies are branding some of their clothing lines as being sustainable or organic or green in some way. And then actually when you delve into, for example, their production lines or into the materials that are being implemented in these production lines, they're finding that they're not actually as green as initially branded or advertised as. So that is the risk, in that it can bring about reputational damage where companies are advertising themselves as one thing, but actually when you delve into the when you open the bonnet, so to speak, you find that they are not actually acting in as green a manner as they have held themselves out to be doing, okay? And then finally, we did mention pensions when we were talking about this event. This is something that pension funds will be considering as well. There's now an obligation on pension fund trustees to think about ESG for the first time. Now, some pension funds may have already been thinking about ESG to give them the benefit of the doubt, but others won't have been. And so they need to take this into consideration when making investment decisions. But there is a complex balance, and John and I are going to have a little bit of a discussion later on about the impact of all of this. But there is a complex balance because pension funds have an obligation to take their fiduciary duties to the investors very seriously, and they need to weigh up risk and returns when making any decisions in relation to a pension fund. So it is a tricky area in that regard, okay? I'm going to touch very briefly, so as not to bore anyone who is not in funds and financial services to death, on some of these core regulations. And if you are interested, I'd welcome you to come back after us to speak to us about it. We'll have more information on ESG and SFDR and other regulations coming up later in the semester and next semester. And I'd be more than welcome to, well, you'd be more than welcome to come along to any informational sessions that we'll have on those. But just to kind of give you the whistle stop tour, I wanted to touch on something called the taxonomy regulation, which, as I mentioned at the start, is looking to give a standardized classification to what exactly a green activity is, you know, and it's touching first of all on issues relating to the environment and climate change, but it will build on other areas as it goes along, and it tries to get this standardized definition across the EU. It's been very, very contentious. Different EU nations have different viewpoints on what can be classified as environmentally friendly, what activities are greener than others, etc., etc. So it's taken a lot to get to this point where we have a standard set of regulations, and indeed it is not yet fully implemented due to some of those difficulties. Okay. We have another set of regulations around disclosures, so the Sustainable Finance Disclosures Regulation, and that is where funds have to now disclose to investors. They have to be transparent with investors on their activities, how green their activities are, the extent to which they're investing in renewable energy, green finance, for example, the implementation of green finance in their financing schemes, etc., etc. So it's for the first time opening up this world to ensure that investors can understand the extent to which a fund in which they might be invested in is complying with ESG requirements, etc. And it's becoming more important than ever, but we'll touch on that later in our discussion. And then I've also touched on there new changes to the Corporate Sustainability Reporting Directive. So previously this was known as NFDR, Non-Financial Disclosures Regulation, where some companies were obliged to report on things like gender diversity, pay, etc. In their companies. But now this has opened it up to more companies falling within the remit. And for the first time, they are going to have to report on their environmental activities, on their carbon outputs, etc., etc. So it's putting a lot of pressure on businesses in a wide variety of industries to gather this data, in many cases for the first time. So it's a hot topic across many industries at the moment. And then finally, this will be of more interest to anybody working within the fund space directly. There are some changes that have come afoot to the UCITS and the AIFMD regimes, but I'm not going to go too far into that because it's a little bit outside the scope of our discussion today. Okay, so I'm just going to briefly move on to note this is the SFDR. It talks about the categorization of funds funds, but as I said, is more specific to the funds industry. And I'm not proposing to delve into too much detail here, but it will bring about more disclosures in fund prospectuses on their websites and in their reports. As I mentioned, there is updates to the Corporate Sustainability Directive, which modernises ESG reporting that companies need to report on and will affect large companies and listed companies. So that comes into effect from 2024, and it'll be really interesting to see the broad number of companies that will have to report on this and how they classify their own ESG activities, okay? Before we kind of go on to a discussion on the impact of all of this, and we'll be welcoming more questions and answers into that session as well as we finish that up. I did want to briefly touch on, and I'll maybe pass you back to John on this, on how ESG can benefit those who are making investments in this space. And I suppose a lot of people would say that there's a lot of cost that comes along with the implementation of, ESG and sustainable finance, and it comes with more regulatory burden, it comes with higher resourcing requirements, etc. But what might be the benefits for the funds that are investing in ESG? So I'm just going to move to the next slide and maybe pass you on to John to have a quick chat about this before we move to our kind of impact discussion at the end. So thanks very much, John. Back to you.
Okay, thanks, Aisling. And I suppose, I mean, over the past, I say even 3 or 4 years, there's been an explosion in the amount of tools that are available to portfolio managers and fund administrators as well to around performing ESG analysis. It's been, I suppose, it's been nearly a little mini industry in of itself. So in a nutshell, I suppose these are kind of what are these? These are a set of tools that will ensure and will allow portfolio managers to look more closely at ESG issues when making their investments. And I guess the kind of things that they might be looking towards is this kind of idea in the top left-hand corner there about this notion of pricing in externalities. And again, this is this idea that not all the costs of our activities are costed into the price of a product. And it is likely that in the near future that government policy and EU policy will move more and more towards including some of these externalities into your cost base. So, for example, there has been for quite a while there's been a carbon pricing regime, but at the moment only about a fifth of carbon produced in the EU is subject to carbon pricing, and the price is actually does not probably reflect the cost that is incurred. So I just had a look before we came on the call. A ton of carbon emission is now priced at around 90 euros in the EU. Some are arguing that needs to be up at around 900. So you can see how the impact of this, if it was at 900 euros, would that would have a significant impact on the bottom line of some of the companies you might be considering as a portfolio manager to invest in. The other thing I suppose it does is that it encourages portfolio managers to kind of manage idiosyncratic risks, or to look at the idiosyncratic risks of the companies that they invest in. And by that I suppose we mean those idiosyncratic ESG risks. And they're now required at one level, and also it would be to their benefit to look, okay, should I invest in a coal mining company? Because there's a significant risk that in 5, 6, 10 years, coal mines will end up being stranded assets. And those assets might end up being valueless because nobody wants to use coal, and the cost of using coal might be way too expensive. And that goes across, I mean, I just picked the coal mining example because it's an easy one, but that goes across a range of different activities. So, and it's not just from a kind of a fossil fuel. As you think more and more about the ESG risks of your activities, then it will encourage you to kind of make portfolio investment decisions that will be more in line perhaps with the longer term profitability of your portfolio. It does also encourage investors on the top right to look at, our investment managers to look at a lot of the more intangible factors as they make their investments, and it's not just purely predicting the future cash flows and discounting those future cash flows to arrive at an expected share price, because there's a lot of things that could influence those future cash flows, and you can see them there on the screen, and I won't go through them in return. And I suppose the ultimate piece in all this is that, can a portfolio manager generate performance by investing in through an ESG lens? there was up to recently, there was, I suppose, the mantra was, if you use ESG to drive your investment analysis, you're automatically going to be investing in companies that will have a higher cost base, for example. That kind of view has been largely debunked at this stage. There is some evidence, considerable evidence, to suggest that ESG portfolios outperform non-ESG portfolios. By the way, you'll also get other studies that would say the reverse, but the kind of the dominance would be towards the fact that ESG portfolios tend to outperform, and that's, I suppose, also kind of to a certain extent, it's capturing the fact that companies that are strong on ESG are probably well managed, well governed companies anyway, and that there's, I suppose, a kind of an overlap effect. Okay, so and so there's, I mean, there is I suppose the point of this is that there is, I suppose, a business case from a portfolio manager to employing an ESG approach in deciding on their investments. Okay, so maybe actually, if we kind of maybe have a look, let's have a quick chat around the discussion, and maybe, I suppose, the first question is that I throw out, and Ashley, you might speak to it if you wish, is this actually having an impact? In other words, is there more money coming into these kind of funds relative, say, to elsewhere?
Yeah, so I suppose because we're going into the discussion bit, we might throw out our caveat that this does not constitute financial advice in any form. Myself and John don't hold ourselves out as financial advisors or anything. But I think what we're seeing is that, for example, there are a number of sustainable fund flows that coming into Europe, and there has been an increase in sustainable finance being made available in the last number of years because of this. However, what we're also seeing is that actually funds that were previously categorizing themselves as ESG have had to recategorize themselves. So before they might have said we are, AAA ESG, they're now actually finding with the new classifications, they're not actually holding themselves out as AAA. They're having to downgrade themselves because there's obviously more onerous requirements. So it's a little bit difficult to know if there is an increase in ESG investing, or is it more a rebrand as such, and that's maybe the more cynical view. But one thing I think that is important to note is that there has been a lot of flack in the press, particularly recently, for some of the funds that were classified as ESG, and then when these new requirements came in, they had to change or downgrade themselves to other categories because they weren't fulfilling all of the reporting requirements. But actually, I would argue that that's not necessarily evidence of greenwashing, or them holding themselves out to be stronger on ESG than they actually are, but rather that this is such an area that is such in flux at the moment. These requirements are constantly changing, even from month to month. The guidance is changing. So where you might classify yourself as an ESG fund one minute, the next minute a different piece of guidance might issue. For example, under SFDR, there's these things called these Article 8 and Article 9 classifications, where you either fall into one bundle or another, depending on the activities that you're doing or the investments that you're making as it relates to ESG. And those categories changed significantly when further guidance was issued, and the investment managers were having to, for the first time, fill in templates and the level of reporting that they have to do, and the actual ratios of investments they were making. And that was unforeseeable because obviously these requirements didn't exist until that point. So it's an area that's constantly changing, and it's one that I think merits a little bit of discussion in terms of how best to make sure that the overall goal is achieved. One of the arguments that has been made is that this area has become so complex that it's actually dissuading investment managers from going into the field of responsible and sustainable investments, because they are afraid of not meeting some of the requirements and therefore being found to be greenwashing. So I think that's something that merits a little bit of a look at as well, because ultimately what we want to do is encourage people into this field and encourage more funds into this field in order to, I suppose, get to that goal of net zero. And I suppose back to you, John, in terms of your thoughts on that.
Yeah, if you just maybe go back to the previous slide there, Aisling, I suppose one of the kind of the standout items of that is that you can see that there's a lot of extra money coming in. Sorry about that. Is that there's a lot of extra money coming into what might be considered to be sustainable funds. That, I mean, if you were to accumulate that up, it's in the trillions. Okay, and that's a lot of money flowing in. Again, also Europe tends to be leading the way. and the rest of the world is, I think, a little bit slower to follow suit. So I suppose one of the things that I suppose we can probably stand proud on is that Europe is moving quite a bit in this direction and is moving quite quickly. And that's one of the challenges with, I suppose, with sustainable investing and this kind of general problem around climate change. There is generally there's a reticence on individual countries to move, because they don't want to be seen to be maybe, I suppose they don't want to be seen to be imposing costs onto themselves and not on and everybody else not sharing that burden. Europe has moved, I suppose, in advance of many others. And again, then when you look at, say, the other side, you could view this as a negative. This was, Morningstar, they downgraded quite a large number of European listed funds from being seen as being very strong from an ESG perspective to being maybe not so strong. But I think, as you pointed out, Aisling, this is, I suppose, the movement that's happening in the industry generally. And I suppose it's indicative of kind of the more stringent regulations that are now in place, stopping companies, or stopping funds, I should say, from maybe calling themselves or branding themselves as being super duper from an ESG perspective, when in effect maybe they're a bit more lukewarm towards it. And I think this is probably progress as well, that we are probably becoming more alive to some of the issues that are involved. And even when we look at what we're looking at there are plenty of kind of funds that are performing reasonably well in the higher categories, in terms of the AA and the A categories as well too.
Yes.
So I think we're pretty much, I think, at the 40-minute mark there now at this stage. I guess will we maybe see if there's any questions out in cyberspace?
Sure. So I just say again, if anyone would like to speak, please raise your hand and we'd be happy to unmute your mic. Again, we're not muting you for the purposes of keeping you muted. It was really just for meeting administration purposes, but we'd be more than happy to hear from you. Or indeed, if you'd like to ask any questions around this space, you'd be welcome to pop it into the Q&A button. And the only reason we've disabled the chat is that we don't have two discussions going on concurrently. So we've decided to use the Q&A button because people can comment on particular questions via that platform. So if you'd like to pop in any questions there, please do. And I suppose while we're seeing if we have any more questions, one question that has come up in this area that we might just have a brief chat about is the short-termism versus long-termism debate. And as I said, John and I are not portfolio advisors, portfolio managers. We don't manage any funds or pension funds. We just teach in the area of funds. John is a fund accounting lecturer and my background is fund regulation, so not in the investment management space. But I suppose one thing that comes up very frequently in the ESG sustainable finance debate is the profits versus the short-term profits versus the long-term outlook in terms of ESG. And I think we were speaking about this in another medium, and one thing that seems to be coming up quite regularly, and one area of focus for investment managers, is that there is a need to have a long-term outlook on this. Okay, in some instances, ESG or sustainable finance may not be seen to be the most short-term profitable investment, but one of the arguments that's out there, and obviously there are counter arguments for this as well, is that long-term this is the direction of travel that investments are going, and that there is a risk of something called a stranded asset, or I suppose an asset that is left out in the cold, that has lost its value down the line if an investor doesn't decide to move with the trajectory of travel of any particular industry. So do you have any other thoughts on that long-termism versus short-termism debate, John?
Yeah, okay. I suppose my kind of contribution here is, and I'll take the fund side on this. I think a lot of funds, would not be the bit. I suppose they're not necessarily the enemy in this debate, to be honest. Many investors into funds tend to be long-term investors. If you think, why do people invest in funds? It's for your pension, and it's a long-term investment that for most people, when they invest in via funds, ultimately it'll end up as part of a pension pot for somebody. And these are kind of 20 and 30 year and 40-year investments. So, if you're thinking week to week and month to month, or even day to day, for that kind of when you're making those kind of investments, it would be a mistake. And in the longer run, certainly, you need to have a view on ESG and the sustainability of your investings. I suppose the enemy here in this kind of discussion is effectively the day trader that will be buying and selling on kind of in very short term, very short term horizon. But typically, many funds would take a much longer term horizon in making their investments. And I suppose the challenge here would be to move the markets more generally towards longer term focus in how they make their investments.
Mm-hmm. Mm-hmm.
Just bringing your attention to a question in the Q&A there, guys, if you want to take a look.
Perfect. Thanks, Isabel. So I suppose, does an increase in ESG funds mean degrowth for other more polluting sectors? That's a very interesting question there from Aoife. And I suppose when you mean an increase in ESG fund, mean that there may be a slowdown in sectors such as fossil fuels, etc. I assume that's the perspective there. And I suppose, well, one of the arguments I think for in the campaign for net zero and the move of the kind of capital flows from one industry to another is that they're encouraging transition. So I don't think the aim is that you are going to have a whole sector of unemployment and a whole sector that is going to be, I suppose, collapsed. The idea is, for example, if you have a sector that is historically seen to be a little bit less environmentally friendly, that improvements are made to that sector in the way that it's operated, or indeed in the nature of the products that it offers, so that it can be seen to be more carbon friendly or carbon neutral. John, do you have any thoughts on that?
Yeah, I suppose when you look at kind of the direction of travel of the EU regulation, yeah, for sure, I think there is a preference that new money will be targeted towards sustainable activities, but also built into, say, the taxonomy regulations and everything else. There is an appreciation that industries that are maybe dirty industries, or probably, I suppose, environmentally more harmful, that if you require investment to make your activities less environmentally harmful, that's captured. So effectively, yes. Say, for example, you're producing cement, which would be typically a high energy type of activity, and you're using fossil fuel electricity. Well, if you decide that you want to put in wind turbines on your facility, and you want to finance those wind turbines, well, then the taxonomy is devised in such a way that that kind of investment will be prioritized. So it's not necessarily going to damage, say, polluting sectors, but it will certainly encourage those sectors to become less polluting in the future. And that's the incentive that's there to drive that level of, to I suppose, reorientate capital flows away from kind of the dirtier industries towards either making those industries less dirty or straight across the clean industries. Okay, so I hope that's kind of addressed that question to some extent. Does anyone if there's any other questions? I think we're pretty. I see that we're kind of at we're at 12:46 now, as far as I can see, and we're kind of at the 3/4 of an hour mark. Aisling, do you have anything else that I think may need to be addressed? Or
no, so I suppose just to note that this session again has been recorded because a number of people expressed interest in getting a high level sense of what ESG and sustainable finance is all about. This has been a very introductory look at it, and we will indeed be focusing more as an academy on the area of ESG and financial services as we go through some of our further events later this semester and next semester. If anyone is interested in coming to any of our future events, I'd recommend you follow us on LinkedIn or fundsacademy.ie. We also have our website, fundsacademy.ie, where we detail some of our information sessions as well as our programs. We run a certificate in regulated investment funds and also a part-time master's in investment fund administration. So if anyone would like to hear any more about what we do in the Funds Academy between MTU and SCTU, you'd be more than welcome to check us out there. But just to say thank you so much for giving up your lunch hour to join us. I hope that you've come away with a little bit more information than you knew before about ESG and sustainable finance. Again, it's just a whistle-stop tour. If anyone has any questions, questions, or you find you're actually a little bit lost about the whole area and you'd like to know more, please feel free to get in touch afterwards. John and my email addresses are here, and we'd be more than happy to chat to anybody who's interested in the area. So thank you all very, very much for coming along. Thank you to Isabel for coordinating, and thank you to John for your time on the presentation as well.
Thanks, everyone.
Thank you. Thanks very much.
Thank you.